Hi everyone, welcome back to the channel. Today we're diving into one of the most powerful statistical tools in quantitative finance, the Hidden Markov Model, or HMM. Why does this matter? Because financial markets do not move in one straight line. They switch between calm periods, risk-off phases, and full-blown crises. And if we can detect these regimes early, we can make far more rational decisions about position sizing, hedging, leverage, and even long-term investment allocation. Before we jump into the model, here's the raw market data we used. We combined Jakarta Composite Index, Rupiah currency, Indonesian 10-year yields, US 10-year yields, global volatility through the VIX, the dollar index, and Brent oil. These series reflect Indonesia's true macro environment. When global volatility spikes, when yields rise, when the rupiah weakens, or when commodity prices collapse, financial conditions tighten and risk sentiment changes. Think of it this way: a calm market leaves calm fingerprints, and a crisis market leaves crisis fingerprints. By analyzing these fingerprints across equity market, FX, yields, VIX, DXY, and oil, the model clusters the data into regimes automatically. We don't tell the model what a crisis looks like. The market reveals the regimes to us. Now, let's build intuition for what an HMM actually is. In markets, many things are observable: prices, yields, FX rates, volatility. But the macro state of the market, whether we are in a calm environment or a crisis, is not directly observable. These macro states are hidden. A hidden Markov model helps us infer these hidden states based on patterns in the data. It assumes that markets transition from one regime to another following probabilities, and each regime has its own statistical characteristics. Different volatility, different return distribution, different behavior in FX and yields, and different correlation structure. In practice, investors lose money not because they can't forecast price, but because they treat every environment the same. But with quant analysis, we know a strategy that works in calm markets will fail in a crisis, and a defensive strategy that protects capital during stress will underperform in strong bull markets. HMM gives us a framework to detect which environment we are in, so we can run the right strategy for the right regime. Now that we understand the concept, let's look at the result. Here we have market price in cyan, and the background colors represent the regimes discovered by the HMM. Green, calm; yellow, risk off; red, crisis. You can see the transitions beautifully. Crisis periods during 2011 European debt crisis, 2013 taper tantrum, 2015 China slowdown, 2018 Fed tightening, and of course, the extreme spike during COVID in 2020. Notice how the model sees macro stress before stocks market crashes. Why? Because rupiah weakens, volatility rises, spreads widen, the fingerprints appear before price drops. This is already extremely valuable. We're not forecasting the future, we're detecting when conditions deteriorate. This is one of my favorite slides, the macro fingerprint of each regime. The model finds that calm periods have low VIX, stable USDIDR, tight yield spreads, and small daily moves. Risk-off periods show mild stress, higher VIX, weaker rupiah, and rising yields. Crisis periods show extreme signatures: massive VIX jumps, sharp rupiah depreciation, wide spreads, falling oil, and big stocks market drops. All of this is discovered automatically from the data. Strategically, this means when VIX starts rising and IDR weakens slightly, we may already be shifting from calm to risk off. When both FX and volatility blow out simultaneously, we are likely entering crisis. This fingerprint helps traders adjust exposure before the worst day hits. Instead of labeling each day rigidly, HMM also gives us probabilities. This stacked chart shows how confident the model is that each day belongs to each regime. When green dominates, the market is extremely calm. When yellow starts rising, we are gradually shifting into risk off. When red spikes, crisis probability becomes significant. This is one of the most practical tools for real-world trading. You don't need to switch your position on one specific day. You scale your exposure gradually as the risk-off probability rises. If crisis probability goes above 70 to 80%, you switch to preservation mode. It's smooth, quantitative, and emotion-free. This matrix shows how persistent each regime is. A calm market stays calm 96% of the time the next day. Risk off stays risk off 98% of the time. Crisis tends to persist, but also transitions back to risk off relatively quickly. This gives us fantastic insights. Calm regimes are stable, good for trend following or long equity exposure. Risk-off regimes last long enough to justify de-risking. Crisis regimes typically cluster, not single events, meaning hedges should stay active for several days or weeks. This is extremely useful for position sizing frameworks. Here is the return distribution of Jakarta Composite Index in each regime. Call markets produce tight, positive leaning returns. Risk off has wider noise and more negative days. Crisis contains the worst tail events, the days that destroy portfolios. This explains why treating every trading day the same is dangerous. Your risk is regime dependent. If you run large position sizes in a crisis regime, you're gambling. If you play too conservatively in a calm regime, you leave money on the table. We quantify volatility for each regime. Calm volatility is around 13%. Risk off, slightly higher. Crisis volatility explodes to over 30%. This difference is critical for risk calculation such as stop-loss calibration, leverage decisions, and hedging costs. A crisis regime demands smaller size, wider stops, and stronger hedges. So how do we use this? Each regime can be paired with a completely different strategy. Calm regime, best for buying equities, running carry trades, long-term accumulation, and trend-following systems. Volatility is low and returns are stable. Risk-off regime, reduce exposure, tighten stops, increase cash, hedge FX, use options, or rotate into defensive assets. Crisis regime, capital preservation mode. Cut risk aggressively, hedge currency, use protective puts, or even take contrarian rebounds. This is how large institutions operate, not with a single strategy, but with regime-specific playbooks. HMM gives us an objective way to detect which playbook to use. To summarize, Indonesia's market clearly cycles through calm, risk-off, and crisis states. These regimes have distinct macro fingerprints across FX, yields, volatility, and global factors. The transitions are predictable and persistent. Return and volatility profiles differ drastically by regime. And most importantly, each regime requires a different trading or investment strategy. Hidden Markov models don't forecast the future, but they tell us which environment we are in today, and that alone improves decision-making dramatically. Thanks for watching, and see you in the next video.